This past fall, Horwath partnered with Bank Director to conduct our 4th annual Bank M&A survey to find out what bank executives and directors think about the state of the M&A market. I'd like to take a few minutes to share my insights on some of the key findings. 2/3 of the bank executives and directors that responded to our survey see a more favorable environment for bank M&A. By contrast, only 3% of respondents indicate plans to sell in 2015. Overall, bank executives and boards express a strong desire for independence. Almost 2/3 expect not only to survive, but to thrive over the next 2 years. Bank M&A is a unique business activity because it requires a willing buyer and a willing seller for the transaction to occur, and the number one impediment for buyers is the lack of interested sellers. There appears to be a growing optimism among banks about their prospects to be self-determinant. And this year, 68% of respondents cite the wish of their bank leaders to remain independent as the top barrier to the prospects of selling their bank. In the past 6 years, the banking industry has endured a credit crisis, significant new regulations, and a challenging economic and rate environment. But now, signs of improvement and optimism have emerged, and banks believe they can plot their own course for the future. This perhaps may mean that bank M&A will decline in 2015. Deal activity in 2014 was higher than in the previous 3 years, suggesting that trend would continue in 2015. However, bank M&A peaked in the second quarter of 2014 and has been declining for each subsequent quarter in 2014. It is possible that the deal volume in the fourth quarter of 2014 will actually be lower than in the fourth quarter for the prior 2 years. Considering all of this, my expectations are that 2015 will see a slight decline in the number of transactions, but will still be a steady flow of transactions comparable to the historical rate of consolidation. "72% of the respondents that completed an acquisition in 2013 or 2014 say that post-merger integration was the most difficult aspect of the deal. In fact, this is now the top concern for respondents, even over credit quality. This shift in priority of concerns can be attributed to improved credit quality. While credit quality is still not back to pre-crisis levels, they have been improving each quarter for several years now. In some instances, this may be a result of significant time spent with potential sellers on their credit portfolios. And as such, buyers or potential buyers believe they have a better understanding of the potential seller's credit issues. Additionally, regulators are also focused on the buyer's ability to manage the post-acquisition risk. And it is possible what is being reflected is the impact of recent regulatory review of applications. Some of the other stickier aspects of post-merger integration mentioned in our discussions with various bank buyers are cultural and personnel issues. Often in a transaction, the seller limits access to the seller's personnel, and as a result, buyers may not be able to fully assess the cultural differences between themselves and the seller. Astute buyers develop frameworks from the clues they can identify during due diligence to better assess this risk. Communication is another potential stumbling block that is often not fully appreciated until it becomes critical. For the employees of the selling bank, there will be uncertainty regarding their futures, and also where they will fit and if they will fit into the new bank. CEOs and management must be aggressive in developing and communicating plans for each employee, and to be honest but empathetic about what will happen and the severance benefits provided to anyone who will be separated. One last area boards and management have expressed frustration with are the levels of cost savings expressed versus the actual cost savings realized. In 2014, the largest category of cost savings stated by buyers in their initial presentations regarding deals was 45% of overhead. That is significantly higher than the historical averages, which have been between 30% and 35% of overhead. Anecdotally, boards tell us that they wished management teams would provide more detail about where cost savings will be realized, and also to be sober in their assessment of the added expenses required to achieve some cost savings. As with any acquisition integration issues, project management challenges can delay the realization of savings, and utilizing a project manager can keep the projects on track and increase the probability that projected cost savings percentages will result in actual dollars earned. For additional results from our survey, please visit bankdirector.com or review the first quarter 2015 issue of Bank Director magazine. We look forward to having you join us in the fall of 2015, where we once again will survey bank directors and management to get their insights into the state of the M&A market.